Joining us right now is Roger Ferguson, Fed Vice Chair, former Fed Vice Chair, and a CNBC contributor. Roger, let's talk through this because you have been very right for a long time, and you've also been highly skeptical of the idea that these cuts could come very soon. What did you think after yesterday's number?
Well, I thought a couple of things. One, in some ways, it's unfortunate that the inflation is still running a little hotter than the Fed would like, because, as we know, inflation is a drag and a tax on many individuals. Secondly, I think the commentary from the Fed, I think, had been pushing towards this notion of no rush to cut. We heard from President Bostic possibly only one cut. So I think this, in some sense, supports that side of the commentary. And finally, I think the market was right to simply take the June rate cut probably very much off the table, and now we're looking much later into the year for the first rate cut, if any, occurs this year.
Yeah, the market yesterday didn't just take the June rate cut off the table. It took the July cut off, and people are thinking it's going to be a pretty long, hot summer. I think you're already of that opinion. This just solidified it for you?
Absolutely. Look, the good news here is that the economy is doing very well. I think the truth is we aren't really sure, policymakers, economists overall, exactly how restrictive monetary policy is. Because if it were so restrictive, you would have seen things slow down much more than they have thus far. And so the challenge for all of us, Becky, is post-pandemic, all the changes that are occurring in the economy, so older folks leaving the workforce, maybe changes in how people work, all of that is leading to uncertainty about how inflation dynamics work. And that is paying through in the inability to be really accurate about the inflation call, and therefore, the inability to be really prescriptive and accurate about what the next move is going to be on rates.
There are a number of doves and dovish outlooks out there, Roger, who are able to look at this number and say, well, this number doesn't really take things into account. When you get the CPE number, that's going to show us something different. I'm sorry, the PCE, that's going to show us something different. A lot of these numbers are backward-looking. These are things we knew would be lagging indicators. What do you say to all that commentary?
Yes, first, the PCE has been somewhat lower, which is, I think, net good news, and that helps the Fed a little bit, and it's a patient story. I'm always careful to sort of exclude the things that you don't like. When you start to say, well, you take this one out, you take that out, you can certainly look at this in a more optimistic way if you want. I think that's unrealistic, because if you talk to individuals, what they are feeling is continued pricing pressure. And so I think we should take this relatively at face value. Yes, there are ways to cut it, but I think that leads to a very dangerous situation that we've seen long ago. When you start to ignore the bad parts of the inflation number, you get to a place where the Fed is falling further and further behind the curve. That is not a good idea. So I take this at face value. I do take some comfort that the PC is somewhat lower, but I think the Fed is right to hold off on starting any cuts until they gain higher and stronger confidence that inflation is really coming down closer to that 2% target.